Each speaker has 20 minutes, and I allow 10 minutes for comments, discussions, and reply. Next, I will open to questions from the floor. Okay, let's begin, please.
All right. Thank you to the organizers for putting such a nice event together, and obviously for including our paper into the program. This is joint work with colleagues at the bank, Andreas Utermann, Rishi, Vala, and Jun Yang. The usual central bank disclaimer applies. The views are ours and do not necessarily reflect those of the Bank of Canada or its governing council. The objective of this paper is actually very, very simple. We are trying to understand the impact of demand shocks around treasury auctions on prices across different asset classes. And we are particularly interested in the responses of foreign exchange and bond markets, which are two market segments that share same risk factors and that are highly integrated with each other. On the left-hand side, so we run this like very simple price impact regressions, where on the left-hand side, we're going to have our change in prices, so let's say in exchange rates or bond markets. And on the right-hand side, we have a measure of demand shocks, which I'm going to talk about more in detail later on, how we measure it and the details. But for now, take it for granted and trust me that this is a measure of demand shocks. We're going to have 4 results in the paper. Let me walk you through it, and then I give you a little bit more detail throughout the remaining time of the talk. First result, having the foreign exchange returns on the left-hand side, is that in response to an increase in demand for safe assets, so an increase in demand for treasuries, leads to an appreciation of foreign currencies against the US dollar. Okay, just to be clear, what I'm plotting here is the dollar portfolio, so it's the unconditional average of foreign currencies returns against the US dollar. And I'm looking at the G9 currencies, so the most traded and most liquid currencies in the world. Result number 1. Result number 2, we put bonds prices on the right-hand side. What do we see? A similar response. If there's an increase in demand for treasuries, bond returns goes up, meaning bond yields go down. Okay, so both markets seem to be moving in the right direction. Once we have established that fact, we can obviously start slicing the data in different ways. Here we throw all auctions together in one regression, but we can obviously distinguish between auctions where only short-term maturity instruments are issued or where long-term instruments are issued. So we can split that up. And we see that in general, the pattern is there no matter what kind of treasury is issued, but we see a much, much stronger result for long-term issued for instruments with long-term maturity. That's a third result. For now, we kind of like bunched all currencies and all bonds in one portfolio. We kind of averaged everything out. But obviously, we can run these price impact regression at the individual currency or country level. So we get a price impact measure, a beta, for each and every currency and for each and every bond. If I do that, I get my 4th result, which is the following. On the left-hand side, I have my price impact coefficients in FX. On the right-hand side, I have my price impact regressions in bond markets. So on the y-axis, I plot my beta coefficients for each and every currency or for each and every bond. And on the x-axis here, I'm going to plot the correlation, the short-term correlation between the foreign country and the US. And I'm going to argue later on that this is going to be a crucial component, and it's going to determine to what extent the shock, the demand shock, is experienced in FX markets versus bond markets. Just to be clear, for a market like Canada that is highly integrated with the US and that moves very, very closely, a shock, a demand shock, has almost no effect in FX, but it has a huge effect in bond markets, right? So the transmission goes straight away through into fixed income markets. On the other hand, if you look at a country like Japan, where the short rate correlation is pretty low, you have a huge response in the FX space, and a relatively low response in fixed income. So you have this beautiful opposing pattern of negative correlation in the FX markets, accompanied with a positive correlation in bond markets. Okay, that's our fourth result. How do we get to these little pictures? I'm going to talk a little bit about the identification strategy, about these high-frequency shocks, and why we are hopefully convincing you that these are really measuring changes in demand and nothing else. I show you a few more empirical results that are kind of resembling the pictures I just already presented to you, and I hope I can convince you that these results are robust and kind of hold across different specifications. And then I'm going to spend a couple of minutes talking about the economic mechanism, because again, the variation across countries that we have observed is highly related to the degree of short rate correlation. And again, that's because both asset classes are exposed to the same single risk factor, which is short-term interest rate risk. Okay? And by setting up this little empirical setting, we believe that we provide quite a good quasi-natural environment to actually provide evidence for this quantity-driven theory of risk premia, which have become quite popular in the international finance literature more recently, where global intermediaries and arbitrageurs play a prominent role in driving asset prices across different asset classes. Different streams of literature we believe we contribute to. There is obviously a literature on quantity-driven demand shifts. Famous papers are those by Gorinchus and Greenwood in particular, but obviously there's a bigger literature on the importance of demand and how we measure demand shocks using, or in asset pricing in general, using new methods. There's, if you look here at the years, a very recent stream of papers that looks at the importance of treasury auctions and the demand of safe assets and how that may have changed over time. Obviously, a big literature on high-frequency shock identification in the monetary policy space, and we're going to adapt like a similar logic and apply these high-frequency changes around treasury auctions in order to get these demand shocks. And then, there's obviously a recent literature on the impact of quantitative easing and to what extent, unconventional monetary policy affects asset prices across different spaces. So that's sort of the plan. It's an empirical paper, so data matters. We focused on the period 2002 to 2018, which is sort of like a low inflationary period, which is in line with these quantity-driven risk premium models that we have in mind. Information on treasuries you can get on treasurydirect.com. It's publicly available data. But what's important to us is that we need high-frequency data in order to identify these demand shocks and in order to identify the response, in particular in the FX space, which is a highly liquid market where participants move quite quickly in response to new information, right? So we rely on tick data from Refinitiv for the G9 currencies, so Australian dollar, Canadian dollar, Swiss franc, euro, pound, Japanese yen, Norwegian krona, New Zealand dollar, and Swedish krona, which in aggregate represent about 75% of total trading volume. So they represent a huge bunch of the market. We take that tick data, I clean it, and sample it at the 5-minute frequency to get rid of the usual market microstructure noise you might be concerned about working with this high-frequency data. We do the same for Treasury futures, which we obtain from CME, again, starting at the tick-level data, pulling futures for different maturities so that we can match the futures to the maturity of the instruments that are available at different auctions. So we have instruments with 2 years, but also with up to 30 years maturity. And again, we start with tick data, we aggregate it to 5-minute frequencies. For the bond space, we rely on daily data, which we just obtained from Bloomberg. Simple, global, zero-coupon bonds, widely used in the literature. So nothing unconventional here. These auctions are kind of cool, and I want to spend a minute on why we think it's a quasi-natural setup actually to test our theory. They're frequent and they're pre-scheduled events, so everyone knows when they are taking place. And in contrast to FOMC announcements, where also everyone knows when they are taking place, auctions are actually really, really frequent. So again, FOMC meetings happened 8 times a year, at least scheduled ones, right? The auction space we have auctions almost every week, in particular in the more recent years, which means that we actually have a pretty big sample we can work with, right? Over our 16, 70 years of data, we have 940 auctions. A sizable amount of that is auctioned each and every time. So we have an offered amount of 25 billion. Again, the maturity sort of ranges. So on average, it has a maturity of about 8 years, but it ranges between 2 and 30. And we see that there is always more demand than supply, right? So we can look at the bid coverage ratio, which basically tells you how much participants bid at an auction versus what is offered. If that would be 1, demand would be the same as supply. But as you see, the average is 2.66. So on average, demand is 1.66 higher than what is actually offered. And even the smallest value for bid coverage ratio is exceeding the value of 1. The different people trading at these auctions, the Treasury makes available data for aggregated groups. So we have these primary dealers, which is sort of the biggest chunk here, indirect bidders, so think of these as international funds, and then you have direct bidders, which can bid directly, but they're not necessarily primary dealers. Another thing worth noting is that you see that here on the x-axis, the spacing gets wider and wider, which is sort of like emphasizing the point I made earlier that we get more and more auctions in the previous years compared to the beginning of the sample. Okay, so how do we construct these shocks? That's sort of important. And again, keep in mind that it's very, very similar to this monetary policy literature, which has been very popular in recent years. Treasury auctions, most of the time, take place at 1 p.m. 1.5% don't, but the rest is at 1 p.m. We construct high-frequency shocks by taking the lock price change in 20 minutes around this window in Treasury futures, right? And we're going to argue that the only thing that is driving these price changes in this small window around auctions must be driven by demand for these said assets. Why is that the case? Well, supply is fixed, and it's well known in advance. So if you believe me that nothing else is happening at 1 o'clock, then any change in prices in that window, if supply is fixed, must be demand. Now, important for that line of argument is that auctions are actually isolated events within the trading day, okay? And I want to convince you that that is the case, because obviously there's a lot of work, great work on intraday dynamics. A lot of it focuses on FOMC announcements, which is at 2 or 2:15 in the more recent period, and then maybe you have like a press conference. But it's an hour away from auctions, and also they never happen on the same day. They're macro announcements, but they happen earlier in the day, 8:30. There's an overlap between the two, but it doesn't really matter for our analysis. And then there are a bunch of other daily events that we know affect returns, in particular in the FX space, like the fixing of Reuters, FX option expiry, or closing of equity markets. But again, the important point is none of them is in this like 20 minutes window around auctions, right? So I want to alleviate concerns that anything that is happening intraday on a systematic basis is driving these price changes around auctions. How do these shocks look like? Well, this is what you see here. They're quite sizable. They range between minus 40 and 80 basis points, go up and down as you would expect for shocks to be the case. They have quite a bit impact in the FX space and an even larger one on the bond side, where again we use daily data to measure these returns, okay? But the important thing is there is no systematic pattern, there's no bias towards an appreciation of foreign currencies or depreciation of foreign currencies. They move up and down as you would expect. So then, equipped with these shocks, we can run these very simple price impact regressions. If you believe me, those are demand shocks, that's a natural next step. Again, on the left-hand side, we put changes in prices, either in FX or in bond markets. Right-hand side, we have our demand shock. We can start by focusing on the pooled regression in both markets, where we basically look at all auctions together, independent of the underlying maturity of the instrument that is issued. And you see that in FX, we have an average response to one standard deviation change of 2 basis points. In bonds, it's about 8.5. Then again, we can kind of like split that up into individual buckets. So we can group the auctions into 2-year, 5-year, 10-year, or 30-year auctions. You see the number of observations vary quite a bit. But the important thing is that the response to demand shocks is monotonically increasing from the short end of the curve towards the 30-year bond, right? For the 2-year auction, you have a response in bond markets of just about 1 basis point. Compare that to almost 40 basis point for long-term auctions. So, it already indicates the term premium really are at play here because that's sort of the only difference between those two instruments. Now, you could argue, well, this is 20 minutes, why should we care? But in the paper, we argue that these shocks are actually quite sizable and persistent, right? So it's not limited to this 20-minute or 1-day window. They actually persist for a long period of time. So what we're going to do here is we're going to run simple local projections where we run our shock measure on the cumulative changes of returns over several days ahead. And we see that in the FX space, returns are sort of positive and significant, at least at the 10% level, for almost 3 trading weeks. And for the bond market, it lasts even longer, right? So arguably, these responses to demand shocks are quite relevant for financial markets, and they do not disappear immediately. They are persistently there over several trading weeks. Now, I don't have time to go through all of this, but we do quite a bit in the paper to convince the reader and ourselves, of course, that these results are robust. Now, for example, you could think that FX and treasuries are just moving in the same direction every day, no matter whether there's a treasury auction or not. So we run some bootstrap exercise to kind of alleviate the concerns and show that, price impact coefficients on these days differ significantly from each other. We look at alternative window sizes. We use alternative intraday FX data sets. You might be concerned about the indicativeness of some quotes that dealers don't have commit to what they're actually posting on pricing streams, or that quotes are just stale. So we repeat the exercise with executable tradable prices, and we get similar results. We look at alternative measures. In particular, we look at this big coverage ratio, and we show that changes in quantity give us the same or very similar replies or responses as the changes in treasury futures. Seasonal effects are not at play, so end of month or portfolio rebalancing there is not driving it. And neither do crisis versus non-crisis periods. So I would argue pretty robust result. So the question is, what's the mechanism in place? And we need to understand the risk premium dynamics in these two markets to do that. So why do these markets co-move, and why do we have this different response in both market segments? One way to think about it is to think of trading strategies global intermediaries or arbitrageurs are usually pursuing. So in the FX space, that would be the UIP trade. Think of it as a carry, where you, as a US-based investor, you fund your trade in US treasuries. You swap your dollars into, say, Canadian dollars. You invest in the GOC market. You hold that for 1 period, and then you swap that back. Unless the exchange rate moves in the direction that offsets that interest rate differential, you're going to earn an FX risk premium on that trade, the carry trade, right? Has been pretty popular over the last 20, 30 years or so. In the bond space, the yield curve trade is sort of like the easiest to think about. What you do, you kind of borrow at the short rate IT, and invest in an instrument that has a longer maturity. Then the yield on that trade is going to be your average expected short rates over X period ahead, plus a term premium component, which is obviously going to be larger the longer the investment horizon of the underlying instrument is going to be. So now what happens if the short rate is increasing? Well, if your short rate is increasing unexpectedly, it means that the prices of treasuries are going to jump. If prices go up, we know that yields must go down. If yields go down, it must be because there's a change in the average expected short rate, which shouldn't be the case because in that window, nothing is happening about the short rate, so the term premium must go down. So the short rate really matters for that trade. In the same way, that short rate matters for your carry trade because your funding cost, your IT, is going to go up, which makes this trade relatively more expensive compared to the previous case where IT was lower. Now, the response in each and every market obviously then depends on how much IT star is going to respond to the change in IT. So the co-movement between those two really matters here. And that gives us this nice cross-sectional figure that I showed you in the beginning, where again, I have this individual price impact regression coefficients here on the y-axis and the short rate correlation, so the co-movement between IT and IT star on the x-axis. And again, we see that's decreasing in FX and it's increasing in bond space, right? So that tells us a little bit about the cross variation across markets. Very briefly, we can also think about the time variation, right? So treasuries are not always considered to be a hedge. Sometimes they're actually considered to be risky. In order to assess that, we reconstruct June Pun's recent stock-bond correlation measure using high-frequency data, and we kind of assess to what extent each day when a treasury has an auction is considered to be a day where treasuries are safe or risky, right? We would expect that if US treasuries are considered to be a safe asset, that the response, in particular in FX market, is quite different. So we kind of extend our price impact regression by an additional dummy variable here, and we see that that's positive and significant, meaning when our rho is positive, so we are in a risky regime, meaning treasuries and equities move in the same direction, we have a stronger appreciation of foreign currency, while if US treasuries are considered to be a safe asset, that response is weakened or even reversed, which is in line with these convenient yield stories we have heard about a lot in recent years. I'm running out of time, so let me just say we run additional tests, and I just want to leave you with these 3 pictures, which I hope you're going to remember after today. We have these significant responses to demand shocks in both market segments. Foreign currencies appreciate, foreign yields go down. Those responses are persistent. They last for longer than just these short windows of 20 minutes. And there's a very strong heterogeneity across these 2 markets, which is sort of emphasizing the importance of the same risk factor that both of these markets share. Thank you very much.
Thank you, Gomar. Now, Julian Caballero will present his comments.
Okay, thanks for inviting me to present this my paper and discuss this great paper by the colleagues at the Central Bank of Canada. This is a very interesting paper that, again, I'm going to go over it quite quickly after his presentation was quite eloquent and well presented. It's a paper that presents evidence of spillovers of demand shocks for US treasuries into yields of foreign sovereign bonds and bilateral exchange rates against the dollar. The analysis is great work of data using high-frequency changes in prices around auctions of US treasuries to identify these demand shocks, and then paired that together with the high-frequency data for exchange rates and daily data for sovereign bonds. And they studied this sample of 944 auctions in the sample of the years 2002 to 2018, and studied the effects on sovereign bonds and bilateral exchange rates against the 9 economies, advanced economies. He didn't have enough time to go over some of the interesting results that are actually using the information from the auctions that is quite interesting, breaking down the bid cover ratios, using the bid cover ratios as proxy for demand shocks, and then breaking down the results by bidder and investor types, which I think are one of the interesting results of the paper, but sadly we didn't have enough time to go over those during his presentation. The key findings, as just to repeat, a positive demand shock for U.S. treasuries is correlated with a depreciation of the U.S. dollar or an appreciation of the foreign exchange rate, as he expressed, and an increase in these advanced economies bond yields. And these effects are increasing in the maturity of the auctioned U.S. treasury. And then in the cross-section, there is some important cross-sectional heterogeneity on these effects, and with the correlation of U.S. and foreign with the effects being increasing in the correlation of the U.S. and foreign short-term rates, and these effects are stronger for countries with higher co-movements of short rates with the U.S. And interestingly, the results when breaking down by investor type, indirect bidders that are most, as I understood from the paper, mainly composed of foreign central banks and institutional investors, explain most of the documented pass-throughs. The response of foreign currencies is also amplified when a larger share of treasuries is allocated in the auction to foreign investors and investment funds. Those are really interesting results. And as I'm gonna put in my comments later, is somewhat unclear how these relate to the models and the mechanisms at play. But I find that these results are quite interesting, and I would like to see a little bit more of that and understand better why is that the case. My main comments are divided in these bullets. First, I'm going to say something about the execution of the analysis. I'm going to ask the authors to go deeper a little bit on the intuition of the mechanisms at play and how these demand shocks from theory are mapped to the data. This is the version of the paper that I read is preliminary work, is work in progress. So it benefits from comments at this stage, which is good, but it also requires more polishing on the presentation of the data and the presentation of the methods. I think the authors can improve the paper a lot, and then there are some minor comments related to a more careful check of the drafting. Okay, on the execution of the analysis, my main concerns relate to the lack of concern about omitted variable bias and possible cross-sectional dependence in the data. So the baseline models in the results in table 2 of the paper, which are the graphs that he showed at the start of the presentation, they basically only introduce country fixed effects as control variables, basically. And although they take care or account for the possible correlation of the standard errors using Driscoll-Cray standard errors, that baseline model, in a way, neglects interdependencies across endogenous variables and units, so the countries or the currencies, omits common factors that, and also disregards general equilibrium constraints, which is a critique of any model that does not take into account seriously any cross-sectional dependence. And of course, in the pool model, the results that you saw before, it restricts the responses to be identical across units. Although in the paper, they do have exercises by currency and by country. So I think that the main comment that I have on the execution of the analysis is that these concerns should be taken into account seriously. On the one hand, there is indeed important cross-sectional dependence in the data. If you look at the correlations of movements in both currencies and daily, daily changes in currencies, and these are the correlations among the levels. So this is the correlations among just the levels of currencies and the correlations among the bond yields in levels. You see that there is important correlations between, for example, the currency in Australia and New Zealand. And that certainly should go beyond whatever is coming from the demand, the identifying shocks to investors' demand in auctions in the US. So that type of cross-sectional dependence should be taken into account. The same happens with bond yields. There are correlations among these that are beyond whatever is coming from the auctions in the US that are identified and controlled for, is the variable of interest in the model. So my main suggestion is that they should complement, they didn't necessarily replace that as a baseline model, but maybe complement the analysis, estimating other types of models that could be the mean group estimator of Pesaran and Smith, or the common correlated effects estimator of Pesaran. They also have these local projections regressions that go to 30 days ahead. Again, there are some models like the dynamic common correlated effects that can be used to estimate those effects. I also think that these type of estimators that do not impose a common coefficient across countries, but can take into account there may be differences across units, should be the baseline for the average effects of what is the pool model. rather than taking averages of the country-specific regressions in the DOL portfolio that he showed in, and that is, for example, presented in Table 3. And I think that the paper also should have a more extensive discussion of the limitations of the methods that are presented, and particularly taking a little bit more seriously concerns about omitted variable bias. For example, a few questions that I have there is, whether the pool model should add a dummy for the treasury's tenor. The pool model, I guess, it was not crystal clear from the presentation, is the pool model across maturities. So I'm asking whether there should be a dummy variable for each tenor. Anyways, so that's one comment. The other main comment that I had is to give more intuition about the mechanisms. It doesn't help that in the paper, in different instances, when they explain the narrative, or they go over the narrative or try to explain the mechanisms at play, the writing refers in different stages at appreciation of foreign currencies or depreciation of the dollar. That makes it a little bit confusing. There are also instances in which they explain the mechanisms in terms of an increase in short rates in the US, but actually the effects that are actually identified are decreases in the short rates. So there are different aspects of the paper that can be improved in the narrative, in the presentation of the narrative. And then it would be very interesting, as I said before, that how these interesting results, when breaking down the auctions by investor type, how do they relate to the theory? How do they relate to the motivating models? Because that's not clear at all in the paper. And then a couple of questions about the data is why the sample only covers 8 ends in 2018. If you bring the data to 2024, the sample would increase by about 37%. I think that would be quite a good improvement. These results also feel a little bit stale with data until 2018. And the last question is why not include emerging markets in the analysis? When you look at the data on foreign exchange turnover, this is from the BIS triennial survey, a bunch of emerging market currencies are actually as important in spot and forward transactions as some of the emerging markets. The case of Brazil, that is not in the table, this is because the data relies on OTC derivatives, and in Brazil, about 40% of the FX transactions are done in exchange traded, which is one of the countries with the largest share of exchange traded FX turnover. But it would be interesting to see whether those results also map to emerging markets. And I guess another important question that I have when pulling the data for sovereign bonds, how do you treat the different levels of these bonds? If I understood correctly from the paper, the authors take the data at face value without doing any normalization, but indeed there are important differences in the levels of these sovereign yields across advanced economic countries. If you go and expand the sample to emerging markets, that would be even larger differences. And that's basically my main comments. My time is up. Appreciate the opportunity to comment in this paper. It's great. It's a great paper with a lot of promise, I think, and particularly going a little bit deeper on the interesting results about different investor types. So I stop there. Do not go over my time.
Julian, thanks so much for these thoughtful comments and for the great discussion. Let me touch on a couple of your comments, and then we can see if there are questions. So I guess in the entire literature on high frequency identification, the assumption is always that within that short window, nothing else, no other information is released that is moving prices, even though prices across asset classes obviously can move due to other factors on a lower frequency basis. So even though Australian dollar and New Zealand dollar are highly correlated because they are the same investment currencies, during those 20-minute window, no new information is released to investors other than that it's coming from the auction. So we kind of take this line of argument, which is laid out in the Ray and Gorodnichenko paper, kind of as given and apply that. But the point is well taken that we need to spell that out more clearly. And I guess relatedly be in general more consistent. So thanks for pointing that out, and spend more time on explaining the mechanism, in particular how it links to the quantity-driven models. The other point about the sample and the data, I mean, so when we started, we kind of wanted to be agnostic about what the role of inflation potentially is. So we kind of focused, similar to these theories, on a period where inflation is relatively low. So that's why we stopped in 2018. And then we were kind of asked to extend the sample period also for policy purposes. But extending high-frequency data samples is time-consuming and costly, so we're working on it, and in particular, the recent months have kind of proven that it's an interesting environment to study, so we actually want to go until 2025, no matter what the level of inflation is. And hopefully we can extend to EMEs, but for now, we just have the G9 currencies, and that's what we can work with. Again, thanks so much for taking such a close look. Sorry for the errors, we're going to iron them out, and yeah, thanks again, really helpful.
Now you open to questions from the audience. Okay.
So Ingomar, thank you for the presentation. Well done for the very interesting paper. One question that I have is relates to the excess demand measure that you create. I was wondering if, I know order flow data is very hard to get it, but I was wondering if that measure is correlated with order flow from the FX market. And if not, if you cannot do that because of the lack of data, if you could map the effect sort of from the microstructure literature, right? A billion excess demand, what would be the effect, for example, on the spot rate? So that's the question. Thank you.
Excellent point. So we also started looking into some of the spot order flow from referendative matching, at least for some of the currencies that are more actively traded on that platform. We're still looking into it. It's not entirely clear whether trading in inter-dealer market is really taking place on the exact same point in time, or whether dealers are sort of like building up the inventory maybe ahead of it. So we're not sure what we're going to find, but we look at it. It's a great point to potentially look at like some information share types of measures, actually like Hasbrook style. That's a good point. We should be able to do that. Yeah, thanks. That's great.
Any more questions? No? So I can move to the second paper, which will be presented by Julian Caballero.
Okay. So I want to present this paper with Christian Upper, a colleague at the Bank of International Settlements. The standard disclaimer applies. Anything that I say here is my words and do not reflect the opinions of the Bank of International Settlements of its board of directors. And in this paper with Christian, what we do is we take a look at occasions or episodes in which there is a rapid increase in yields in the US, and we ask what are the factors that are associated with those episodes that end up being correlated with negative outcomes in asset prices in emerging markets. So when US yields in the US go up, then immediately there is a concern about emerging markets. There is an old question and recurrent in the media and policy circles. Here are some examples of the headlines, but the key question is yes, there is always a concern about emerging markets. asset prices and capital flows. In this paper, we're going to look only at at asset prices. In a previous version, we also take a look at capital flows, but we ended up narrowing down our research questions only to asset prices. And in this paper, what we do is we come up with a methodology to identify these episodes of rapid increases in long-term US yields. And we're going to relate that to 3 asset prices in emerging markets: nominal exchange rates against the US dollar, local currency yields of sovereign bonds in emerging markets, and equity prices. And our identification of episodes of sharp increases in US yields, we're going to call those episodes yield spikes. And that identification will be based solely on the behavior of US yields, irrespectively of the reasons behind the increase, and irrespectively of the outcomes in emerging markets. So we're agnostic about what is driving this thing. We're just a data-driven approach to identify those episodes. And in the cross-section of those episodes, we're going to study what happens to emerging market asset prices. We're going to do that asset price by asset price, but we're also come up with a way of summarizing the intensity of the negative outcomes to emerging market asset prices into a single metric that we're going to call, following some literature, coexceedances, which is basically the number of negative outcomes. So basically, across for each country in the sample. And we're going to relate these to the possible drivers. There is a large literature on international spillovers of US monetary policy to emerging markets and advanced economies. That literature is mostly focused on US monetary policy shocks, basically FOMC, events around FOMC announcements. So that's somewhat different from what we do in the sense that we look at actually increases in yields. There are other strands of the literature that has looked mostly at time series or even studies. And again, that contrasts with our approach of looking at the cross-section of these yield spikes that we identify. There are, of course, many papers to cite. The key papers that are related to the work we do are listed here. And in particular, the composition of US yields into expected rates and term premium from Kurkuru et al. And Mehrotra, which find that there are indeed spillovers of both expected rates and term premia into emerging market yields. And the paper by Al-Bagli et al. In Journal of Finance, which find an important spillover of increases in US term premia that spill over to increases in US term premia in emerging markets. There is also a recent strand of the literature looking at increases of interest rates in the US and how the different motives or the different drivers of those increases, whether it's related to inflation or growth concerns in the US, how there are different effects in the spillovers to emerging markets, with the inflation-driven yield increases being the worst offenders for both asset prices and capital flows. Those are the papers listed there. So our literature fits into, our paper fits into that literature, but our approach is somewhat different. The key findings of the paper are, indeed, there are negative outcomes for emerging market prices when there are across these yield spikes, and those negative outcomes are more likely when these yield spikes go hand in hand with a rise or an increase in the US term premium and US dollar appreciation. Those are the most salient results in what we do. The effects are economically significant and highly nonlinear, and are robust to a variety of sensitivity checks that we do. Other results that are not as robust and hold in the different exercises that we do is that US inflation expectations and growth expectations also matter, but those results are not as robust to alternative specifications. And of EM fundamentals, we can say that they matter little, with maybe the exception of inflation expectations for exchange rates and current account deficits for equity prices. That's the overview of the results, and let me go a little bit more deeper on exactly what we do and how we obtain these results. So we are gonna focus on identifying these yield spikes episodes, and we're gonna compute start to peak changes in 3 asset prices. So basically, from the start to the peak of the yield increase, we're gonna compute the percentage change in the bilateral nominal exchange rate, the US dollar, the change in local currency sovereign bonds in the yields, and the percentage change in equity prices. Data availability will restrict the main analysis from to January 2004 to June 2024. And we're going to look at basically 17 major emerging markets, excluding the hard pegs, and the countries are listed there. And to identify these yield spikes, we're going to adapt techniques from the business cycle literature on turning points to this daily data on long-term US yields. And we're going to identify these local, these yield spikes. First, we are going to identify local peaks and troughs as local maxima or minima in windows surrounding of 30 days. And we're going to define these yield spikes as periods between, there is something missing there. But what we do is basically, we're going to define as a local candidate of maxima minima the periods between troughs and peaks on windows of 30 days, and we're going to impose a minimum size of the change from trough to peak of 1 standard deviation of the typical 30-day change over the last 5 years. So that's basically the way we identify these events, these episodes. These yields, this is going to lead or result in 34 episodes of yield spikes, which are in this plot. And basically what we do is, yes, we get the time series of long-term US yields, and we're going to identify these windows of minimum 30 days changes, and we result in these 34 different episodes of rapid increases. These rapid increases, again, are above 1 standard deviation of the typical 30-day change in these yield spikes. And we basically identified what you could imagine are the main events, the main episodes that you could map to rapid increases of yields in the last 20 years or so. You shall paint it there. The mean change from start to peak on the yields is about 84 basis points. The average duration is 102 days, and so these are typical. The typical events, although there is important heterogeneity in these events. Some of the events are up to 46 days, and also there is also important variation in the size of the yield increase. This is in basis points. Now, across these yield spikes, this is what happens to these 3 asset prices in emerging markets in their changes from start to peak, from start to peak. And what you see is that in general, doesn't happen much. It's on average, there is basically no important change in the exchange rate. Local currency yields do increase a little bit, although not 1-to-1 in emerging markets, and equity prices actually increase. But in some occasions, there are outcomes that are actually pretty bad. There are occasions in which there are important overshoots of the nominal exchange rate in emerging markets and important spillovers to local currency bonds in emerging markets. And basically what we try and do in this paper is to, okay, so what are the different factors that may correlate to these negative events in the cross-section of these yield spikes. And we're going to look at a wide number of candidate variables that may explain those negative outcomes. We're going to look at characteristics of the yield spike, the size of the change in the yields, the speed of the yield increase. We're going to look also at global financial conditions, including the change in the U.S. term premium, the change in the dollar index against advanced economies, proxies of investors' appetite for risk as VIX or high yield corporate spread in the U.S., prices of commodities. We're going to use at U.S. financial conditions in the United States, including break-even inflation, what is going on in the equity market in the U.S., and an index of macro surprises. We're going to also look at growth and inflation forecasts for the U.S. at the beginning of the spike and the change before the spike on those forecasts. And we're going to also look at 12 different fundamentals in emerging markets. We're going to look at what happened to policy rates, which are basically a reaction, the policy reaction. And on the fundamentals, we're going to look at the previous appreciation of the nominal exchange rate, previous bond and equity flows, the change in the Standard & Poor's rating of the sovereign debt, inflation and growth expectations, the level of the sovereign rating the sovereign rating by Standard & Poor's, the level of international reserves, the current account balance, and openness of the capital account, and the exchange rate regime. So we're going to cast a wide net of possible drivers of these negative outcomes in emerging markets. We're going to be agnostic about which one could be the best candidate, and we're going to basically do a data-driven approach to identify which one of these factors is actually correlated with these negative outcomes in emerging market asset prices. For that, we're going to implement a strategy from machine learning that basically helps us identify the key covariates driving these negative emerging markets in a setting in which we have a large number of potential explanatory variables, and we have a somewhat reduced number in the cross-section of yield spikes. We're only 34 yield spikes, and we're trying to identify whether any of these 29 potential variables has a significant effect on each one of these emerging market asset prices. And for that, because there are concerns about overfitting and valid inference, we're going to use this method of double-step lasso from the machine learning literature. This is somewhat new literature from Beloni and Chekorsnukov. What this double-step lasso strategy does is basically it's going to run first a lasso regression for the variable of interest that you want to get inference about on the total possible of the total set of explanatory variables, and identify the variables that come significant in that regression. Then it's going to run a different regression on the dependent variable on all the set of possible explanatory variables and identify the ones that come up as significant from that regression. And then it's going to run another regression of the dependent variable on the union of those two sets of identified significant variables. That's basically what the algorithm does on the back. And I invite you to go over the papers by Beloni and Chekorsnukov showing that that's actually a very solid strategy to get inference on variables when you have the high dimensional model as this one. And we're going to implement this strategy one potential variable, one by one. Again, because selection on the lasso regression is going to be on the set of all variables, you can see these results, although is this one dependent variable, one variable of interest at a time, you can see these results as jointly determined, in a sense. We're going to also obtain results with two different clusterings of the standard errors, and we're going to find that the clustering matters a lot in the inference. We do not have a preferred way of clustering the errors here. There are different good reasons to cluster at the spike level or at the country level, or not clustering at all and use those robust standard errors. We're going to present results at the spike and the country level clustering. And in the analysis of coincidences, basically what we're going to do is we're going to compute the number of extreme realizations, negative realization of these asset prices by country. We're going to count that, and we're going to estimate an ordered logic model on the number of coincidences. This is how that looks, the number of coincidences, but let me show you some of the results. So the baseline results, again, this is one variable by one variable, and what we're going to get is that basically the variable that across the different specifications comes out as significant as driver of negative outcomes in emerging markets. So larger changes in exchange rates, positive, meaning a depreciation, larger changes in local currency bond yields, meaning overshooting of the local currency yield, and falls in equity prices is the US term, the start to peak change in the US term premium, and the start to peak change in the index of dollar against advanced economies. So that's the key result that we find first, the baseline result. The third result is that for each one of these asset prices individually, break-even inflation in the US seems also to matter, and also the changes in growth forecasts in the US. For emerging market fundamentals, it seems that none play an important role beyond the inflation forecast. A higher inflation forecast seems to be correlated with more negative outcomes in emerging markets in the cross-section of the yield spikes. And also the current account balance, meaning a current account deficit, seems to be correlated with a fall in equity prices in emerging markets. So that's basically the main results that we get when we do the analysis asset price by asset price. When we put together the three asset prices in this coincidency analysis and estimate this ordered logic, we don't get here a good way of selecting by variables, as in the covariate selection strategy of the double-step lasso. So what we do here is we implement some sort of manual covariate selection, estimating the model one variable each at a time, then all variables at once, then the global and US covariates, which are common across yield spikes, in one block, or the emerging market fundamentals in another block. And then we look at what are the ones that come up as significant in many of these instances, and estimate a model we call key covariates, and another model that we call final covariate, with the ones that came out significant in that key covariate model. And again, what we get is that the drivers in the coincidences analysis are mostly the same. The start to peak change in the dollar index, and the start to peak change in term premium. And in this coincidences analysis, in the case of fundamentals, also the exchange rate regime come out as significant. One way of getting at the nonlinearity of these effects is looking at the implied probability of the realization of coincidences, from no coincidences 0 to 1, 2, 3 coincidence. And what you get from plotting those implied probabilities that you obtain from the model, the most parsimonious model here in the final covariates model, in the last column, is that the effects are quite nonlinear. So when the change in the US term premium is low, like in this part, you have a high probability of having 0 coincidences. But when the change in the US term premium is very large, you have a high probability of a larger number of coincidences. The same with the dollar index. The effects of the current account balance, for example, in this analysis, are more like flatter line. They are not as non-linear as the effects of the US term premium or the dollar exchange index. We run a battery of robustness check. Particularly, we have, I don't present it here, but we have a robustness check looking at the size of the spike in basis points, and we also look at the different components of the change in the U.S. term premium, expected short rates, or the changing of the composition of the yields of the, meaning whether it's the change in the expected short and the average short rate, or the change in the term premium. And what we find is that the results are robust, and then we run all set of the robustness checks. And I'm not going to bother you with those, but we get that basically what I said before. The main drivers of negative outcomes across yield spikes in emerging markets are these changes in US term premium and dollar appreciation. Now, in the 1 minute that I still have, hopefully, we don't have a nice narrative for these effects. In the case of dollar exchange rate, there is important literature looking at the risk-taking channel of exchange rate, and that's somewhat well understood in the literature. But in the case of the US term premium, we don't understand well what would be the case. What would be the case that changes or rapid changes in US term premium would be correlated with negative outcome in emerging market asset prices. That's something that would be a follow-up and interesting to look at, but we do not have a good narrative in the paper for that. That's all I have to say. I'm sorry to extend my time for a couple of minutes. The window for the Explorer.
Oh, it's open in the back. I see. All right. So, thank you to the organizers for letting me discuss this paper. It was a really interesting read. So I think Julian did a very good job explaining what the paper is about and what they do. So I'm going to sort of give some comments overall on how I view sort of the motivation and the questions that the paper is asking, and then some comments I had. Some of those are going to be conceptual, some of them methodological. So there is this sort of massive existing literature out there on the effects of US monetary policy on emerging market economies. Sometimes people are looking at short-term effects, sometimes longer-term effects, sometimes people are looking at specific episodes or just sort of throughout history. Overall, there are many different conclusions, but one of the most sort of broadly accepted ones is that there are large spillovers, and those spillovers are state-dependent. And there's a really high salience for this, for policymakers in emerging markets as well as in the media. You saw the big list of headlines that Julian showed. So, the thing is, when we look across time at different events, we see really heterogeneous outcomes. When you have sort of massive, big spikes alongside massive economic disruptions like the collapse of Lehman Brothers, you see small changes in the main outcome variables of interest. On the other hand, the taper tantrum, which is not accompanied by much fundamentally changing in the US or Europe either, you see huge effects. So, the motivation here is to understand sort of why these effects are different across these different events that occurred at different times and in different environments. So, I found the results very, very interesting to read. There are a couple pieces conceptually where I would have liked to see a little more exploration. The first, and I'll get to this in a sec, is just to consider foreign currency yields at all. When I sort of read this, the title of the paper, I was not reminded of the taper tantrum. I was not reminded of the COVID thing. So I work on a lot of things related to sovereign default. So I thought of the 80s and Latin America, when there was massive US yield spikes, and across emerging market economies, debt crises. And these were generally externally held foreign currency debts. So it will be interesting to see to what extent the methods employed in this paper yield results that are familiar to the literature on determinants of foreign currency yields. Next thing I would be interesting to see, especially because it's framed as one of the main contributions of the paper, is some just empirical exploration of the channels by which this term premium effect might be operating. Then there's some methodological comments that I'll expand on when we get there. But just to remind you of what happened in the 80s in emerging market economies, this is a picture taken from a paper by Victor, Carlos, Tim, and Juanpa. Some of you may know, I think, Tim and Juanpa. This is a paper about the effect of changes in US interest rates on debt sustainability in emerging market economies and on the outcome of renegotiations. So this is actually the real interest rate rather than the nominal one, but they both feature this massive spike, right, in 1980. And following that, there's this huge increase in the number of countries in default. And almost all of these countries are emerging market economies. And Brazil is in here. Brazil defaulted several times in the 80s. So this is the picture that I thought of when I read the title. So that was in the 80s, though, when the data that they're using is not sort of as widely available. Thing is, 2004 to 2024, you have US dollar or euro bond yields available for, I think, almost every country in the sample. And those determinants are well studied. So I'd like to understand whether the patterns around yield spikes match the long-term patterns, or if there are sort of specific things operating in those circumstances that we should understand better. And also, are there major differences between the effects that we see for foreign currency yields and local currency yields, and why? So, as far as the term premium effect goes, it would be interesting to see some exploration of the channels here. It could, to the extent that you can look at how much larger the effects of this change in term premium are in places that have a very sort of long maturity structure versus for liabilities, either public or private, versus countries where the maturity structure is at the start of the yield spike is much shorter, right? And so a lot of that is going to have to be rolled over, potentially at higher yields. The other thing is to take a look at how important the banking sector is for the transmission of this yield shock to the broader economy. So, now that was the sort of conceptual pieces where I'd be interested to see a bit more exploration. I have a few comments about some of the methodologies. So there is this sort of normalization of the size of the yield spike with respect to a trailing 5-year standard deviation of monthly changes, and no other variables are normalized in this way. Now, in the paper, there's this line saying a given change in BIPs is not proportionally the same at different levels of rates. And there's, yes, there is a sense in which that is true, but that's an argument for normalizing by level, not by standard deviation. The thing is, these yield spikes are already in percentage points, and it's already sort of a normalized number, in a sense. It's a percentage point, and it's a percentage point that accumulates over a unit of time, right, a year. So generally, I don't really see a need to normalize that at all. In my opinion, that should be the baseline. And for what it's worth, they do have this as a robustness, and a number of the results remain true. I think it makes more sense to use this as the baseline, or alternatively, to use similar normalizations for all the other variables that are this trough to peak term. All right. So the last comment relates to the use of this econometric method. Now, I am not an expert econometrician myself. I saw this, I had to go and pull some of the papers that are referenced, and then I read some of the forward citations of those too. So my understanding of this is that it's something that is designed to estimate the effects of some predetermined set of covariates of interest. And it's really useful when you have a wide set of controls and, crucially, possible confounders, things that you don't really care about so much, but are concerned that they may be correlated with your covariates of interest D, and want to allow yourself to control for. Here, though, there's no ex-ante declared variables of interest. And so they repeat this procedure for every variable, and that means that the sets of the conditioning variables differ sort of cell by row and by column. You're seeing sort of each cell is from a different regression. And that can make it difficult to compare coefficients to each other and sort of interpret the results in any sort of joint way. Now, normally if you sort of have a predetermined set D that is smaller than the full set D and X, you can do the identical procedure, but you just repeat it for every D, right? It regress the Ds on the X's, and then you take the union of that first regression and then all of your sort of D regressions. But here, because everything, they're doing this for everything, that's not really possible, but I'd still be interested if there was any way to obtain some common set of conditioning variables, at least sort of column by column. That would make it easier to interpret some of these results. They use this sort of ad hoc procedure that in some ways resembles the lasso procedures to get the set of covariates for the nonlinear case. And there is this sort of these papers about why, for a linear model, this is a robust way to do inference, but I couldn't find any sort of theoretical justification for doing something similar as they are in the nonlinear case. So I thought this was a very interesting paper. I would like to see it take a little more time to explore some of the channels by which some of these main effects could be operated, especially this term premium channel, given that that's not one that has been written about so much. And then there are these empirical comments as well about standardizing some variable normalizations and to see if that if those sets of right-hand side variables can be fixed to help us interpret these results a little more cleanly. Anyway, so thank you.
Would you like to reply? Sure. Yes.
So thanks for the comments, all well taken. Let's start with the main one, I think, which is, yes, we do not have a nice narrative and a good explanation why this standard to peak change in US term premium ends up showing up as a driver of these negative outcomes in asset prices in emerging markets. That's something we need to do more, to explore a little bit more, perhaps as a follow-up of this rather than as part of the paper, but it's a point well taken. We do not have a good narrative for what is going on. On the other comments let's start with the conceptual ones. On the long-term patterns, sadly, we don't have data on local currencies yields before 2004 for many countries. Although in one of the robustness checks, we extend analysis to start in 1990. We do have data on exchange rates for that. And for most equity markets also starting in some places in 1998, 1996. And the results hold for the longer term period. You pointed out that we don't look at foreign currency yields, only local currency yields, and that's a good point. I guess the reason behind that is that nowadays, but not in the past, nowadays, most of the sovereign debt of emerging markets is denominated in local currency. But actually that's not the case in the past. So point well taken that there is something that we can do there, and data on that is easily, going back to the early 2000s. You also pointed out that there may be other potential drivers of negative outcomes on the EM fundamentals, the maturity of the liability side. That's something that we didn't take a look at. We only took a look at the ratings of the sovereign, and also the change in the last year on that rating. And also you pointed out that banking sector and the fundamentals of the banking sector may explain some of the results. We have not looked at that, but that point well taken, that that's something that we can do. And on the normalization of variables, I guess the concern there is that we wanted to not identify these yield spikes. We wanted to make sure that these were large yield spikes in the context of how the level of the yields were moving. So the yields at the beginning of the sample in the 1990s in the US were, 7%, 6%, but towards the end of the sample were 2%. So we didn't want to, we wanted to normalize in a way to know that we were getting large increases with respect to the recent movements. And what we ended up was defining it, the average change in the last 30 days change in the last 5 years. But that's kind of the motivation of that. But again, we can also do it the other way, and that's something to take a look at. And you pointed out that we do have a robustness check looking at the change in basis points, and the results are more or less there. And about the DS Lasso methodology, that's a hard, I guess that's the most difficult thing to implement, because given the way this double step Lasso algorithm works, it's not designed to get inference on the whole set of conditioning variables. It's designed to get inference, so meaning whether it's significant or not significant statistically. One variable or a set of few variables of interest at a time, conditioning on a very large set of possible confounders over which you select. But we cannot implement this in a way that you select over, that you get inference over the whole possible set of controls. So that's a comment that I don't know how to tackle, but I will think a little bit more about it. So, thanks for the comments.
Thanks, Julio.
Now I'd like to open to questions from the audience.
Thank you. So there's this view that emerging markets have been more resilient since the pandemic, and you see that the macro response has been milder compared to previous crises. So I wonder if you see this in the data, if you see that asset prices movement is milder now in response to this kind of risk events in the post-pandemic, and if you see that in your results. And also, if you have considered looking at the distribution across countries and how it depends on macro fundamentals and macro policies and how sound they are. So imagine looking at, for example, central bank independence and other fiscal policies to see whether these asset prices kind of are showing perceptions of people that, emerging markets, even though they're exposed to these shocks, now that they can cope better with these tail risks.
So, true, in the last few years, what we have seen is that emerging markets have been more resilient given the shocks. There are indeed large changes in US long-term yields in a couple of recent years after the pandemic. And what you see is that little has happened in emerging markets, both in exchange rates and also in local currency sovereign yields. We have not looked at in this analysis to the set of couple of spikes or 3 or 4 spikes since 2022, 21. So I cannot say analytically what we would find if we just limit our analysis there. All I can say is that indeed, it seems that in the last years, emerging markets have been more resilient. Now, when you look at the different analyses that have looked at that, is in part because most of these large emerging markets have a strong credibility of the central banks, that you pointed out at some point as one of the main possible determinants, possible drivers of this. So they have been able to anchor inflation expectations and also respond nimbly to these external shocks, adjusting interest rates, and that I would say translate to stability in the exchange rate. It may be interesting to add to the set of potential controls central bank credibility, as you pointed out. I don't know if we can get data back to early 2000s on that, but that's possible. So, thanks for the question.
Any more questions? No? So you can proceed to the third paper, which will be presented by Stelios Forex. Okay, sorry.
That's okay. All right. So first, thank you to the organizers for putting this on the program. I know that I'm standing between you and lunch, and so I'm going to do my best to keep things as short as I can. So this is a paper about what happened in 2020 and what didn't happen in 2020 at the onset of COVID. So you look at 2020 and you see sort of across the world, not just advanced economies first, really large, massive in some cases, recessions. Now, in advanced economies, there was basically universal response to this, which was to implement these unprecedented transfer programs that were funded almost entirely by debt. And in spite of that, sovereign spreads barely moved. And they barely moved even in places that just 10 years earlier had been in debt crisis. I mean, in Europe, there were 5 countries that had debt crises, 3 had to be bailed out, 1 defaulted. And they entered 2020 with similar debt levels. They have big recessions and borrow and start borrowing massively. Nothing happens. And that sort of goes against a large literature that goes back to the 80s about why in risky countries, interest rate spreads are high and default risk can be high. In that situation, that literature says spreads gotta go up. Right? You enter a recession with high debt and you don't come back on borrowing, spreads are on the way up. So, question of this paper is, well, why didn't spreads increase during COVID in advanced economies? This is not a question that we think has no plausible answer at all. It's a question that we think has many, many plausible answers. And the purpose of this paper is to distinguish between those. And we're going to build this sort of very big machine to do that. We're going to build this machine and we're going to discipline it with data from prior to the COVID-19 crisis, and then we're going to put COVID into the model in a very careful way. Now, this model is going to be designed to test potential explanations. For example, the role of of official support for countries by the ECB in the pandemic emergency purchase program. We also know that COVID was a shock, and the lockdowns associated with COVID were a shock that impacted the non-tradable sector very differently from the tradable sector. Second, we know that the impacts of COVID were heterogeneous across the income distribution, that poor households were much more likely to lose labor income and to lose more of it than richer households were. And we also want a model that has private sector savings as well as a labor supply decision, in part because during COVID, in advanced economies, during the response to COVID, we saw large rises in gross savings, and we want to be able to assess what role that played in this lack of response in spreads. So we disciplined the model using data from 2002 to 2019. Now, we are going to use data from Greece to do that. That's not because we are only interested in why spreads didn't go up in Greece. It's because Greece has a lot of really useful information variation for a bunch of key parameters here. Greece had very high spreads, some of the highest that have been observed in any advanced economy in at least half a century. It did default, it had very high debt, went through a very large recession, and it got a large amount of official support from the IMF and the European Commission and the European Central Bank. So we think this is sort of a really useful case to help us identify some of these key parameters. And then we're going to go to 2020. We're going to put lockdowns into the model, and we're going to run a wide variety of counterfactuals to assess, well, if this other thing had been different, right, if the ECB had not intervened, for example, how much higher would spreads have gone? So, quick preview of the results. The most important thing that we find is that this shock was perceived as relatively transitory, as not lasting very long. And that's very important because this shock is a very dangerous shock for debt sustainability, because it's a shock that hits poor households very hard. And that provokes this massive government response, right? This massive desire to do more redistribution. And if that desire is expected to last quite a long time, then it lowers long-term sustainable levels of debt by quite a lot. And as those sustainable levels of debt fall, spreads rise. Spreads would rise. In Greece specifically, there's also this issue of the composition of debt in 2020 being tilted a little more towards official debt than is sort of the historical norm. Things we find that weren't so important, but the first one I personally expected to be quite important was post-2020 ECB policies, in particular the Pandemic Emergency Purchase Program. Now, in sort of on path in history, it turned out that this shock was perceived as relatively transitory. But if it had been perceived as longer lasting, then these ECB interventions we find would have been would have had much larger effects, right? So interactions here are important when it comes to this statement about the post-2020 ECB policies. We don't find a major role for these private sector responses or for things like moral hazard, the decline in the safe rate, or the maturity of debt. There's one sort of broad set of explanations that we don't have a great way to test that relate to implicit guarantees. One way of interpreting ECB policy announcements in 2020 is not just as sort of temporary support, but as sort of permanent changes to the level of implicit guarantee that the European Central Bank was willing to provide European sovereigns. And this is something that we can't fully test within our model, and we believe to some extent is not fully testable in any model. And here's why. If you give me enough flexibility about expectations for future interventions and in what states they'll happen and how much the intervention will be, I can match any sequence of observed yields. And so this is sort of a theory it's very hard for us to falsify without externally disciplining those beliefs. And that's not something that we can do right now. So this is a quantitative paper. And so I told you spreads should have gone up. Here I'm going to tell you by how much. So here you see some data and some predictions. Right? This solid blue line, that's the observed sequence of spreads monthly. Then there are all of these non-solid lines. All of these non-solid lines come from regressions of interest rate spreads on some set of on some set of covariates, as well as some set of fixed effects for some sample. So, for example, this here, this red line, dashed red line here, this just uses data from the countries that had problems in Europe, and it uses time and country fixed effects. And then that delivers some set of coefficients, in particular coefficients on debt to GDP and GDP growth. And we use that to predict what spreads should have looked like after 2020 if the patterns that existed prior had still held. So you get a wide variety of estimates here. Here's one that is estimated only on the basis of Greek data. So in terms of how much missing spread we want to explain at the end, we're looking in the neighborhood of 5%. And there's this paper, a very nice paper by Krouchas and Trebesh from 2013 in AJ Macro, where if you take their coefficients and plug in the changes in debt to GDP and GDP growth, you would get 4.5%, right in the neighborhood of us. So I'm going to go pretty quickly through the model because I want to spend more time with the results. So everything you see in orange is going to be a shock in the model. And we're going to try to sort of very carefully measure shocks in the data so that we can feed them into the model. So the timing is sort of relatively standard in the sovereign default literature. This is the timing of Eaton and Gersowitz. You have some sort of shocks that are realized. Then the government decides whether to default. If it triggers this default, there may be an intervention by an official lender. And if it does not default, then there's some transfers and debt decisions. I should say, so it is not the case that in every environment you could think of, secondary market bond purchases with profits rebated to the country are identical to, secondary market bond purchases are identical to sort of direct lending. In this situation where the profits end up being rebated to the country as they're realized, it turns out that there is an equivalence there, and so we're going to treat all the secondary market interventions as well as the sort of direct lending sort of the same way. And if you want to see the proof of that, it's in the paper. So we have two sets of households. Remember before I told you that there were rich, that the shock had different effects on rich agents and poor agents? Well, we're going to have some set of agents that are richer, that have a relatively higher labor productivity here. Now, all of the agents are going to behave rationally and solve some set of problems. This is the problem for one set of households that are choosing their consumption of tradables and non-tradables, as well as labor and savings, to maximize the discount sum of utility. They do that subject to this budget constraint. These agents, these optimizers, can save, can smooth their consumption over time. We have another fraction. These are the poor agents. These agents will be hand-to-mouth. They do not have the ability to save over time, and we're going to make the assumption that their labor productivity is lower. So on the production side of the economy, pretty simple. We just have the two productivity shocks that move around and linear production. Everything's competitive here. Now, going to the government. The government has some set of expenditures. Some of these are exogenous. In particular, the government spending we're assuming is exogenous. It then chooses transfers, and there are going to be some taxes that it raises, and it's going to finance whatever spending it can't fund via taxes. It's going to do that using two instruments. The first is this defaultable debt issued to private foreigners at some price that's going to be determined competitively. This is going to be one of these sort of long-term bonds with geometrically declining coupons. Then there's also going to be a non-defaultable loan from an official lender, and this is going to have a potentially different maturity rate and coupon rate. Now, the first choice, remember I told you the government is making, is whether or not to restructure. If it chooses sort of some ETA that is greater than 0, that means it's restructuring, and a number of things happen. First, there is a haircut on the debt. Second, there may be a new maturity structure for the debt for some period of time, and the country may start receiving some flow of bailout funds. There's also a cost of default in terms of utility, and then there's a period of temporary exclusion, reentry then occurs with some constant probability. So here is the government's problem. This is the government that has decided not to default and is in good standing, has access to markets. It's going to maximize some weighted sum of the flow utilities to the two types of households and plus this continuation value. In its budget, you see government expenditures, total transfers, total debt service. Those are all the expenditures, and then the revenues are tax revenues, net revenues from debt issuance, and any flow of bailout loans. We are going to assume that transfers to the richer households are lower in per capita terms than transfers to the poorer households. In other words, we're saying this tax system is progressive, and the distance of Xi from 1 determines how progressive it is. Xi, as you see here, this is the ratio of the per capita transfer to the rich agents to the per capita transfer to the poor ones. This is the law of motion for official loans, and so all these choices are being made subject to the government's understanding that after the government chooses, private agents are going to choose. There's a similar problem in default, but when the government is in bad standing, it does not have access to this to issue this private debt, and so it just chooses to transfer, and the budget constraint looks similar with potentially different maturity rates here, and there's no revenue from private debt issuance. So, government restructuring decision, that's made at the beginning of the period, and it is just a yes or no decision, basically. Do you choose to restructure or not? And upon restructuring, there may be some flow of bailout loans that are triggered to start. So, there's a very detailed, in-depth data section in the paper. We do some sort of very careful work in terms of making sure that the data we use to calibrate the model means the same thing as the sort of model analog actually means, that they obey the same laws in terms of their evolution. And it's very cool. I don't have time to go through it today. We calibrate almost all of the parameters during 2002 to 2019. And then we extend the model and think about what happened during COVID. So the calibration is going to be based on sort of measuring carefully a sequence of shocks, or 4 sequences of shocks rather, and then requiring that the parameters that we choose for the model, when I feed those shocks in, there are key sort of observable endogenous outcomes that I want the model in the time series to match the data in the time series. So I'm going to take these sequences here. These are productivity, government consumption, the flow of bailouts, and the tax rate. And then here, in this first picture, you see this boom in the 2000s in Greece, this massive rise in productivity, followed by tremendous 6-year fall. I mean, this is tradable productivity. It falls by over 40%. So, first, we have the real side of the model, output and consumption, and you see we do quite a good job of matching these. So that's the real side. Now we're going to go to the government finances side. And here, we want the model to match in terms of debt quantities and debt prices. So here we see the time series for the data in the model of debt quantities, right, of how much debt was accumulated in the data versus the model. And we do sort of an excellent job matching this. And then we do quite a good job overall matching the spreads as well, in particular the major spike at exactly the sort of right point in time. So that's prior to 2020. Now, in 2020, I'm going to tell you how we put COVID into the model, what we think of these lockdowns during COVID as. We're going to think of them as a couple of constraints on decisions. First, we think there being a constraint during the lockdowns on non-tradable consumption. It's not that the price of going to a restaurant or a movie theater went up, it's that there was no way you could go to it at all. And so we're going to think of this sort of being bounded above for everyone. We're also going to think of labor provision, labor supply by the poor households being restricted to reflect the closure of the establishments where many of them worked. We choose, based on forecasts made in April of 2020, we choose a sort of an expected duration for these lockdowns to be around 2 years. And then we feed in sort of for the realized shocks that there were lockdowns in 2020, but not in 2021. Finally, we let the sort of flow of purchases occur, begin in 2020 without there being a restructuring in that year. All right, so then we tune these parameters here so that the model hits this exactly, and then the fall in non-tradable consumption exactly. And then we have all of these here and here that were sort of not targeted. And so when we get this fall in output right, we get exactly the right increase in debt. We get a very similar rise in transfers and rise in savings. And we also get a very muted response in spreads. Then we get, in 2021, a bounce back in consumption that's larger than the bounce back in output, and transfers and debt continue to rise. So here I want to take you through one of the counterfactuals very carefully. This is the counterfactual where there's no bond purchases by the European Central Bank. So where that delta hat in 2020 is 0. So if that were the case, I plotted 2 schedules. These are the price schedules that the government is choosing from when it decides how much to borrow. Now, this borrowing, how much it's going to borrow, that's on the x-axis, the spread is on the y-axis. And so this is the baseline schedule. This is the schedule had the ECB not intervened. So as you see that the spread menu just generally shifts up. And that's because when you have this flow of loans, there's lower expected issuance of debt in the future because the flow of loans is persistent. And because less private debt is being accumulated, it's less likely the country's going to default overall. Now, when you see here that if the ECB had not intervened, there would have been a little more debt issuance, but it would not have gone up by enough to compensate for the full amount that would have been missing. Here, this is the scale of this intervention in Greece in 2020 was around 10% of 2019 GDP. I mean, this is sort of very large. So, these are the responses of some other variables, right, in these counterfactuals relative to the 2020 model. So we don't get much of a kick out of this, not in terms of prices, but we do get some in terms of quantities. The amount of transfers that the government's able to deliver goes down substantially. Here, we check some other things, including, so this is the debt composition exercise, right, where Greece in 2020 is around 60% official debt, 40% private. If I move that to be 71% of it, private, which is sort of in the long term the average for advanced economies, then we get a bit of a larger increase. We also get a larger increase if I increase the persistence of the lockdowns to match the persistence of TFP shocks that we've estimated. I don't have to do this. I want to sort of briefly examine the nature of the COVID shock and the importance here. If I use, in this model, productivity shocks to generate a recession of the same size, either using a persistent shock or a permanent shock, I don't get nearly the same response in terms of transfers or spreads than I do when this comes from a persistent COVID shock. Now, the reason for that is that these have really different effects in terms of the distribution than the lockdowns have. Remember, the lockdowns, the sort of labor side, that falls entirely on the poorer agents. And you see that here. If I take a look in these 3 cases at what happens to labor income. in the lockdowns, this massive gap opens up in terms of pre-tax income. For the rich agents, it goes up a bit. For the poor agents, it goes down by almost half. This is really painful from the government's perspective, and it really wants to do quite a lot to respond to this. These differences here don't create anywhere near the same effect in terms of redistribution motives. Right? And so if this is a long-lasting shock that produces something like this is really dangerous for debt sustainability. So there's some bits here on interactions. In particular, what if the ECB had not intervened and it had been a persistent shock? Well, then you would have gotten a 5% increase in spreads, and that's sort of everything we were looking to explain in the first place. So in the case of the interaction, this does end up mattering quite a lot. So we have this question: why didn't spreads increase during COVID? Why didn't the dog bark in a case where we would always expect it to bark given history? Here we find two sort of important pieces. One of them sort of general, that this shock was perceived as relatively transitory. Another is more specific to Greece and has to do with this debt composition issue. We find that these purchases did not affect spreads so much sort of along the path where it turned out this shock was perceived as pretty transitory. But so they didn't affect prices so much, but they did affect the ability of the government to deliver these transfers at a time when they were there was a very high marginal return to delivering them. At the same time, we do find that this policy would have made a much bigger difference for spreads had the shock been perceived as more persistent. If you go back to March, February of 2020, when the ECB is deciding this policy, absolutely, in that room at that time, perhaps there was some uncertainty about how persistent this was going to be. And they were thinking about the sort of, given that uncertainty, what's the expected effect of this policy? And in that case, you could absolutely evaluate the expected effect as more than we find in the baseline. So, thank you.
All right, terrific. So thanks a lot for the opportunity to discuss Stelios' nice paper on the puzzling behavior of spreads during COVID. He did a great job presenting a pretty rich paper with a lot of detail in it. Let me try to summarize it in one slide, what I thought about it. It's really an interesting and very topical paper. It's only a few years ago, but we're still trying to understand the dynamics during the COVID crisis. And it's a really, really well executed paper with a lot of attention to detail, in particular when they match the quantitative framework of the model to different very detailed databases for Greece. On top of that, the line of argument in the paper is really nice and straightforward. They have a simple starting point, right? So debt market behavior during COVID seem to be very different to what we have experienced or what we have seen during or following the Great Recession. They were different in the sense that, in both cases, there was a common component, so debt levels, in particular, relative to GDP, was increasing. But they were also differing in the sense that these spreads remained very, very tight in the second crisis, while they're large and quite a lot in 2008 and the following years. The novelty of the paper then is that they produce or build this novel small open economy model that captures these boom and bust cycles based on data between 2002 and 2019. And they argue that these stable spreads that we observed in the data during the COVID crisis are particularly due to two reasons. One is this transitory perceived lockdowns by the public, and second, the less defaultable private debt that has been building up in Greece in response to the sovereign debt crisis following 2010. So trying to put that contribution in like one line is very difficult. So let me just say it's like really, really rich framework. that I believe enhances our understanding how credit markets behave, not only during the COVID crisis, but, I think there's quite a bit of scope to generalize it, obviously to other crises as well, and potentially to another pandemic if we might face one. So the empirical motivation is a little bit this paper. It's always good to have another graph in the discussion than in the presentation. So for the case of Greece, right, you see how debt to GDP, here the black line is rising over time, really like jumping in 2010 and the following years, and then contrast that to this like blue scattered line here, which clearly seem to be correlated during this part of the sample, but then like it really drops, right? And in contrast to the rise in spreads that you see here, you don't really see any jump around 2020 or 2021. So how can we explain that? The model that the authors built has several rich components. So there are essentially 4 different sets, at least, that kind of are new to their model setup. So you have these official lenders that reduce default risks using long-term credit with lower coupon debt. You have sector heterogeneity, so you have non-tradable and tradable sectors that allows you to have real rigidities. And it allows you to distinguish between different factors that are differently affected during the crisis. There's household heterogeneity, so you have this optimizing households, and you have the ones that are poorer, and that they live like hand to mouth, basically from day to day. And then you need to have like a production and labor supply, I guess, to close the model and to drive like savings and intertemporal choice decision. The timing of the model, I try to kind of like put that in a timeline. So period 0, you have exogenous and some endogenous variables states realized at the beginning. Then there will be decisions about debt restructuring and what kind of official loans are needed. You have new debt and transfers in period 3, and then private sector decisions towards the end. So quite a lot going on, in particular if you're not working in that kind of literature. So my first comment is a little bit, can you tell me a little bit about what of these new features is essentially helping you to match this like really impressive pattern of the model with the data, right? So I know the focus of the paper is to match that to the post-COVID period, but at some point I was sort of like wondering how you were able to get this pattern so right, and particularly on the real side. And I guess, potentially one thing is to say, okay, let's hold everything else fixed, just switch one of the features to an extreme value, right? Let's think about all of the households are, almost optimizing. They basically, everyone loses their job and they live like hand to mouth now every day. How does that affect the model? And can you get like some sort of like arrow bands around these blue lines, just to, help a naive reader like myself to understand a little bit better the dynamics of this rich framework. The empirical motivation is, again, another graph they have in the paper, is sort of so when you start reading the paper, they want to compare the global financial crisis with the COVID crisis, but then the sort of like period that they use is obviously the entire 15 years before. So what you do is here you kind of compare the CDS spreads and change to GDP over that entire period to the change in GDP and CDS spreads during those 2 years. And this part obviously includes the crisis because it must be part of your sample, but I feel for that graph in particular, when you're using it for the motivation, it would be sort of nice to know which of, it's probably these dots here, obviously, but, are those the ones that are the crisis period, or would it be actually worthwhile to have a third column here, which is kind of like isolating those few years? And then similarly, these graphs are, so if I understand correctly, these are kind of like average across countries, and then you take bins over time. And I was, and I get to that later on, one more time, it's like, how was that actually looking at the country level? So instead of like averaging across country and over time, can you do something at the country level to put a little bit in perspective where Greece was kind of standing? But I think this potentially a third column here would be pretty helpful to put things in perspective. Okay, so the other big point is one sort of counterfactual you could think about, I think, is external validation, right? If I look at debt to GDP ratios across, not only Europe, but in particular there, you have a bunch of countries, obviously, where, the amount of debt we have been accumulating over the last few years is to some extent maybe worrying. And the question then is, well, to what extent is that mechanism you kind of isolate for Greece generalizable to other countries, right? So can you essentially use other countries as counterfactuals, if data allows, to kind of like pin down what mattered the most to Greece and the other way around? And I think it would kind of, obviously speak then to a broader set of countries, which is always helpful from a policy maker's point of view. But I think even with a focus on Greece, it would kind of help you to pin down which of these model features at which point in time played an important role. Okay, so on the parameter choice. So I'm not an expert on these models, so take it with a grain of salt, obviously, as everything in these slides. But one of your main points seems to be that these lockdowns beliefs really mattered. And I think you take the 0.5 kind of as it's not calibrated, you kind of take that as given. So I was kind of thinking, okay, is there like any way to kind of like empirical evidence that you can argue it was transitory, right? So kind of the obvious thing I was to start with, I thought, was like Google search, right? So I kind of looked at, okay, did people look at lockdown a lot more at certain points in time? And you see, yeah, that was actually the case, in 2020. So if I just look at this like red bar here, then you could argue, sure, that's a pretty transitory spike, and afterwards no one really cared about it anymore. But I mean, we all lived through it, so at different points in time in COVID, we were concerned about different things, and suddenly there was a new variant, and maybe we were not concerned about lockdown itself anymore, but we were thinking about, the Delta variant, and then suddenly, instead of looking for this, we just had a new search term we were looking for, and that, lasted a little bit longer until the end of 2021, I think, if I can read this correctly. All to say, I think it would be nice to have like some empirical motivation where that value is coming from. I guess in the grand scheme of things, 2 years is still transitory. No one believed that these lockdowns lasted for like 10 years or so. But still, I think there's a bit of variation. Similarly, I wasn't sometimes sure how these values were chosen. It seemed like they were very like crisis driven. Like, I guess in particular, things like the loan excess or, the haircut size, those are probably the values in particular for that 2012 period. And I wonder to what extent that is generalizable. But I know you vary them a lot in the latter part of the sample, right? So you even for the lockdown, you use different values to kind of assess what the impact of that is. So some minor comments and questions. I mentioned some to you yesterday. So I wasn't so about this PEPP program. Was it just the announcement that matters, or the implementation? And is there a way to model that differently? In general, announcement might matter more, even if nothing is implemented. From an asset pricing point of view, I was wondering, as I told you yesterday, why should the dynamics be similar between these two prices anyway? One was like, global. One was more country-specific shock. So maybe we need a more prominent discussion of risk premia. Again, I know you have some of that in the appendix, but there was something that came to mind. And then, again, I think the way you're matching these real variables is really, really impressive. Some of the financial ones, maybe a little bit less, at least what I can tell with my eye. But I think what you can do is you can see how you match, what you need to do to match the financial variable a little bit better, and how that makes your match of the real side a little bit worse. And again, it could help you potentially to tease out that mechanism a little bit more that is driving one and not the other that much. I'm out of time, so again, take everything with a grain of salt. I think it's a very timely paper. The pandemic is not too long ago. It's really, really well executed. A lot of attention to detail. It's really impressive. Some nice empirical facts, rich quantitative framework around it. Really recommend to read the paper, and good luck to the authors.
For that great discussion. Going from the end back to the beginning. So we could absolutely take a little more time to explore sort of two things jointly. First, the trade-off for matching sort of a variable on the real side versus a variable on the financial side, but also that can help us also get into the role of each of these model elements in fitting the data. A lot of those model elements were not designed to fit the data per se. They were designed to test things after 2020. But it's still true that we need the data to identify them, right? So that it's similarly important still. To the announcement versus the actual, so it's difficult to distinguish the two in the current period, but you could distinguish it in terms of continuations for following periods, right? So in terms of some of these calibrated parameters, their level, so for the forecasts we could find that were made in in like March, April 2020, most of them, as far as broad economic lockdowns go, not as far as like the COVID period goes, but in terms of like the broad economic lockdowns that kept people home and out of work, there were generally sort of two scenarios. Many places actually explicitly, like the IMF, for example, in the World Economic Outlook in April, explicitly described two scenarios, one where it lasts 1 year, one where it lasts 2. And so it's that and other similar things are where we get that sort of 2-year average number from. The haircut, that's read directly off the data for what happened in Greece, is 47%, but it also matches, that number near 50% does match sort of the broader experience in recent history, the past 20-ish years, where restructurings have been significantly more severe than they were sort of in the 80s and 70s. That delta hat, that likelihood of getting access to official loans upon restructuring, that is disciplined by the data. I would have to get back to you on which features precisely can contribute to setting it. The external validation to other countries, so some of the shocks are identified country by country, and some of the parameters we think are related to the specific nature of the country's political system, for example. That's how, in these models of sovereign default, you often have a government that's very impatient relative to what we typically take for like patience rates for households. And that is usually justified as some political economy friction about liking consumption and spending when a government is in power versus when it's not. And that may be a different friction from one country to the other. The default costs may be different from one country to the other. And so there are some sort of serious computational hurdles there. At the same time, we know that this class of sovereign default model has absolutely been used to study all of these countries. And so there's some sense in which this type of model can match the data from all of them. And this force about the transitory nature of a redistributive shock, that's always going to be active, right? Now, to quantitatively match the specific sort of non-increases relative to predicted increases, that's something that is harder to get at. But I appreciate this. It's something I wish it was easier to do. So that those scatters, those are bin scatters of country year or country month observations, not a sort of average by country and then. Although I'm not sure it's so different anyway. Yeah, we could break out the 2008 to 2014-ish period. It's not something we've done before. I mean, to some extent, it might be interesting to see whether in the 2002 to 2007 period, there's also this flat relationship, or if it's just sort of rising, but on a much smaller scale. Yeah, and so that's it.
Questions from the audience?
All right, everyone, let's go eat.
No? It's lunch time. So, if there are no more questions, we can just stop here. Congratulations, Julia. Congratulations, Gomar. Congratulations, Stanley. Thank you.
Yeah, absolutely.